Hello, and welcome to this week's edition of Checks and Balances TV. Today's program is entitled Spring Cleaning. Get your financial house in order. But first, let's see how today's news may impact your financial future. The national average annual percentage rate, or APR, on introductory credit card offers moved up slightly from a 5-week stretch of 14.65% to 14.67%. Since the recession began in 2007, credit card rates have not stayed the same for longer than 2 consecutive weeks. At the same time, consumer debt is on the rise as well, according to the Federal Reserve. February marked the biggest month in new consumer debt since June of 2008. Okay, so what's really going on here? Let's check the facts using our checks and balances process. The national average annual percentage rate on introductory credit card offers climbed to 14.67% at the end of last month, its first jump since late February. The move was sparked by a federal change in how credit card companies can market their product to students. Due to the Credit Card Act of 2009, and more specifically the new restrictions on how creditors can interact with and market to students, some banks are no longer offering student credit cards, which is probably a good idea. As a result, the top 100 credit card companies have undergone recent changes as banks work to improve their marketing efforts to conform to the new rules. The national average APR has increased by just 0.3 of a percentage point over the last 6 months. The APR refers to the interest rates charged on credit card balances on an annual basis. However, this rate is applied to an account that carries an outstanding balance each month. The way an APR is set has a lot to do with the federal fund rates. Most credit cards are variable rate credit cards, and most variable rates are tied to the prime rate. The prime rate is typically set at 3 percentage points above the federal funds rate. When the Fed rate increases, so does the prime, which lends to an increase in the APR. The Fed, however, has not changed their rate in more than 2 years. This stability must have given comfort to many consumers, as the Federal Reserve reported an increase in consumer debt for the 5th month in a row. As of the end of February, consumer debt had increased by 3.8% to $2.4 trillion. This increase is due to long-term purchases for things like cars or continued education. Revolving credit, however, such as credit cards, have decreased for the 2nd month in a row. Okay, so you may be asking yourself, Matt, what does all of this really mean to me? Well, now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. Thanks to the Credit Card Act of 2009, consumers are now given greater warning when their APR is about to increase. By law, credit card companies must now give a cardholder 45 days notice, except under a few specific circumstances, such as a change in the rate by the Fed or when there is a delinquent activity by the cardholder. In each of these scenarios, the APR can change immediately. Outside of this, credit card companies are free to change their APR at their discretion, as long as they give you a little advance warning. When reviewing the numbers, the drop in credit card debt would indicate that consumers are paying down their credit card balances. However, the increase in consumer loan debt would suggest that consumers are becoming increasingly more comfortable with making large purchases. For example, auto sales have been very strong in recent months. General Motors ended 2010 with its greatest profit in more than a decade, and is on track to do even better in 2011. However, some analysts believe that the recent decrease in unemployment, combined with the sudden increase in long-term loans, would suggest that people have dropped out of the job hunt, making them no longer countable by unemployment standards, and have instead taken out student loans to go back to school. College enrollment numbers are the highest they've been in more than 40 years, back when young adults went to college to avoid the draft into the Vietnam War. Okay, so what's the bottom line here? The economy appears to be slowly improving. The Credit Card Act has made banks more accountable to consumers when they intend to raise interest rates, and the job market is beginning to stabilize. 3 factors that have kept the banks and the Fed from making any sudden shift in interest rates. Banks who have been competing with each other to attract and retain credit-worthy customers during the recession have held interest rates to stay competitive with each other. But as the economy continues to improve, more and more people will become credit-worthy again, and banks will need to do less to attract new customers and make even more money. So now is the time for Americans with good credit to seek out or negotiate lower interest rates on all of your loans. Shop around like you would for a new car and find the lowest rates available, and then eventually pay off that debt. And now for Matt's weekly financial tip, tool, or technique. With spring in the air, today's financial tip is on financial spring cleaning. While it's important to keep track of your finances throughout the year, doing an annual cleanup will help you achieve financial freedom and retirement success. Follow this acronym for the word spring, and your finances should grow all year long. Begins with S. Shred old financial documents. Spring is a great time to get rid of those old pay stubs, financial records, and documents that you've been saving for years. Of course, keep your tax returns, cancel checks, and any records that support tax deductions for auditing purposes. And then get rid of the rest. But remember, it's important to shred, not throw away old financial documents to prevent your identity from being stolen. And then we have P in spring, which stands for prioritize your expenses. With summer vacations and the holiday season just around the corner, spring is a great time to cut down on your expenses. Look over your monthly bills and decide which ones are necessary and which ones you can really live without. You'll be surprised how much money you can save by cutting back just a little. R stands for review your credit report. By federal law, you're entitled to receive one free credit report from each of the 3 major credit bureaus every year. Log on to www.annualcreditreport.com for your report and then do a thorough review of it. If anything on your report causes you concern, contact the company directly to correct any inaccuracies or misinformation. I stands for investigate your insurance coverage. With all of the competitive insurance providers out there today, now is a great time to review all of your current insurance policies and make sure you're still paying reasonable rates. If you feel you're paying too much, shop around, and you may find some annual savings there. N stands for negotiate your rates. Every year, you should make it a top priority to look at each of your outstanding debts and the interest rates you're paying on each of them. Contact your loan provider or credit card company and negotiate a lower rate. And if they don't want to budge, talk to a few of their competitors to see if you can strike a better deal with them. And G stands for go over your estate plan. Another important aspect of financial spring cleaning is reviewing your estate plan. If a marriage, divorce, birth, or death has occurred since the last time you updated your estate documents, take action now to revise them accordingly. By taking time once a year to do some financial spring cleaning, you will be in good financial shape for the rest of the year. In this week's CBTV poll, we're asking Americans an important question. Which part of your financial plan would benefit the most from a good spring cleaning? Log on to answer this poll at www.checksandbalances.tv. And while you're there, take part in Your Voice Counts and join in the discussion. In our On the Street segment, we travel the country to ask Americans what they think about an important financial topic or issue. For this week's show, we ask people their feelings about how easy it is to get into personal debt today. Be sure to log on to our website to view their responses. And while you're there, be sure to watch our newest episode in the Truth About series, which is available now. And it's on the truth about bonds. You will learn the pros and cons, both sides of the coin, on this important financial product, so you'll know if it's the right investment for you. And finally, remember that only you can control your financial future. You can succeed. You just need confidence